Welcome. Thank you for your time once again. What a gap year it has been. It's been a rough quarter since we last spoke and since we last touched on the portfolio performances and what you guys have done in the background. We're sawing new heights in terms of global markets. Tech stocks driving offshore portfolios and markets very, very strongly. We're 90 days out from, less than 90 days out from the US elections. Who knows who the next candidate would be and whether Mr. Trump would be successful. And maybe if I could ask you, Pierre, just to take us through your views in terms of these fundamentals and where we are. How did we recover? Initially, we spoke about the possible U and a W-shaped recovery and all sorts of letters in the alphabet. But where are we relative to what we've discussed earlier on this year and where we were?
Thank you very much, Luciano. Thank you for the opportunity. I just want to check, can you see my screen with the slides?
Yes, I can.
Good. Thank you. So, as you said, just a few slides to show where we're at from a macro point of view and really a very high-level summary. The recovery that we've seen in markets since the lows in March and all the way really up until now has really been driven materially by the global monetary and fiscal support. So a lot of money has been pumped into markets to try and prop up economies, to support companies, to support households, and on the fiscal spending side, through handouts, through tax cuts, 2 to 3 times the stimulus that was done during the financial crisis has really now been done in terms of quantum. So there's a lot of support for the markets, and that's what's been driving the markets of late. I think the easy recovery and the easy returns have been made. There are a number of potential risks for the next 6 to 12 months that we need to keep in mind, and I think that'll take us to a fairly balanced view on portfolios. And those risks to take into account are really COVID-19. There's a resurgence in infections in Europe. South Africa numbers have come down dramatically, as you know. And very interesting, as we stand, the new infection numbers in France and in South Africa is about the same, and the infections in Spain is higher than what it is in South Africa. So I think that's positive for us, but I also think it is a bit of a warning if we look at Europe and see how it can flame up again, that we shouldn't get too relaxed in South Africa in terms of our behavior, firstly, and secondly, also not for what the impact for the economy might be. When the president spoke initially, when we went into the lockdowns, he said this could be a forwards and backwards thing. And obviously all of us hope we don't go backwards in terms of lockdowns. It is a risk that we need to take into account. The US election might cause market volatility from various angles. Hopefully it won't be disputed in any way in the courts. But even if it's not disputed, and for example, if we think of the possibility of a clear-cut win by the Democrats, that's also something that the market might not like, because that might mean bigger oversight of large companies, higher taxes. So I think it will be a challenging period for the markets running up to the elections. And then lastly, the geopolitical risk around China and the relationship of the US and the rest of the world with China, I think will be a challenge in the years to come. But as we stand, interest rates are very low, inflation is very low, and that's positive and supportive for markets. Those increasing rates and increasing inflation is not a problem for this year or next year. There's no inflation in sight, but somewhere in the future that will start ticking up again, and we will need to keep an eye on that as well. When we look at valuations, and I'll show a few graphs on that just now, after the recovery at the headline level, global markets are not that cheap anymore. As you rightly pointed out, the US market have made new highs. In South Africa, our valuations are better, and particularly so on our SA-focused businesses, and I'll show something about that. So if we take all of this into account, stimulus, risks, levels of inflation and interest rates and the valuations, we really want to be neutral in our portfolio stance. So we acknowledge that there's a lot of support for markets, but we also acknowledge that they've run hard since March, and there are certain risks that we need to take into account. So being neutral means we want some defensive qualities. We want more defensive styles, for example, managers with quality style being a bit more defensive. We want exposure to SA bonds because that offers you good yields. We like to see a bit of gold in managers' portfolios. But on the other hand of the barbell, we also want some exposure to the more geared and high beta opportunities. So we do want exposure to value managers. We want exposure to emerging markets. We want exposure to really everything outside the US, which is typically more cyclical than the US. And within those pockets, one also finds things like resource exposure and financials exposure. So it's really a barbell between defensive positions and more aggressive positions. And then lastly, on the currency, the rand is too weak currently where it is. If you compare it to a theoretical level, but South Africa has challenges. But one must be careful for the fact that the rand could strengthen, and not necessarily on our own fundamentals, but maybe because the US dollar starts weakening, because growth in the rest of the world, relatively speaking, improves relative to the US. And then other emerging market currencies can strengthen and can pull the rand up with them. And when that happens, it's a headwind to the global portions of our portfolios. So we are very aware of that. So I'll just go on. The next slide shows how dramatic the stimulus have been. On the left-hand side is monetary stimulus, and on the right-hand side, it is fiscal stimulus on a global basis. And on both of these graphs, you can see the levels of monetary and fiscal stimulus that have been deployed to support the market, or economies really, and that has been driving the markets, is more material, much more material than what it was 10 years ago during the global financial crisis. So it is really material levels of support. If we turn to valuations and markets, what has been going on in markets in the last 10 years, it's really been all about the US, and it's really all about the big tech stocks. And I'll show that now. So since the global financial crisis, effectively, the S&P 500 outperformed materially, and the rest of the world outside of the US, or excluding the US, which is the red line, has really gone nowhere. And within the S&P 500, what has strongly been driving the market are the big tech stocks. If you take them out, you get the S&P excluding the big techs, and that's the red line. And the yellow line, again, is the rest of the world outside of the US. And as you can see, the red and the yellow line has gone nowhere practically in the last 10 years. Now, that means there has to be opportunities for good stock picking managers to access opportunities there, firstly. And secondly, we would also not completely write off the big tech stocks, because in this particular COVID-led downturn, it has been so that the products that these companies sell were the things that were more defensive and were the things that we all needed. So if you look at those names, Apple, Alphabet, Amazon, Netflix, Microsoft, the consumption of those products really describe your entire day of the last 6 months. You got up, you used your Apple devices, you sat on Teams and Zoom meetings for the rest of the day, you did your shopping on Amazon or Takealot in South Africa, and in the evenings you watched Netflix. So it's understandable why these stocks have done well this year, because their products were really what we all needed, and that's not going to disappear. You know, the world of work is changing. People will probably not go back to shops physically in the same way that they did before, because a lot of themes that have been developing over the last number of years have now really just been brought forward through the COVID pandemic, and a lot of those things will stick post-COVID.
Yeah, if I could just jump in here. So maybe just talking about the US elections relative to what you've shown. So the markets have recovered fairly strongly. You are arguing that some of these valuations are sort of very highly valued and possibly in some instances overinflated relative to a possible bid and win. where the ideology in terms of his approach would change in the US. What implication might there be? Apart from the tech stocks still, continuing with the momentum, would there be a possible drive for offshore investors looking at emerging economies once again for opportunity, and might that be a stimulus that we could look at?
I think so. I think a Biden win will be positive for markets and for the rest of the world outside of the US in that respect, because there will be better policy certainty. So Donald Trump is good for business through tax cuts and all sorts of other things, but he's not good for policy certainty because he changes his mind a lot. One thing that we will have more of under a potential Biden presidency is more global policy certainty. They'll rejoin the Paris Accord. They'll sign up to trade agreements that was under threat or pressure under the Trump regime. So generally speaking, I think the gears of the world economy will run smoother potentially outside of the US and through its links with the US if there is a change of presidency. That could quite be. And to your point, this slide shows the valuation of emerging markets relative to the US. And as you can see on the right-hand side, emerging markets have been in a underperforming trend for the last decade, and has really gone sideways to lower in the last number of years. But this behavior of EMs versus developed markets, which is dominated by the US, is very cyclical. And very interestingly, there seem to be about a 10-year span or leg to the up and the down legs of this out and underperforming cycle by emerging markets. So as you can see, it can bob around at the top and the bottom for quite a while. So the timing of when the rotation happens is very uncertain to get right. But we can be fairly positive that over the next 5 to 10 year cycle, there might be better times for emerging markets relative to the US and the rest of the world. And why does that happen? It doesn't just happen because of mathematical mean reversion. It actually happens because economic growth outside of the US gets relatively better, and then money flows from the US to the rest of the world to access those better growth opportunities, and that is what then drives emerging market currencies and emerging market stock prices. And lastly, on the South African market, as an example of an emerging market, this is our mid-cap shares that are really our South African facing shares. And if you just look at the red line, it is a PE ratio. Our market is now as cheap for our local domestic SA-focused companies, as cheap as what it was after the financial crisis. In fact, a bit cheaper, and as cheap as what it was in the early 2000s when there was a serious bear market. Now, we all know South Africa has challenges, but if you buy it at these levels, historically you have always made significant money buying at these kind of valuations.
So, Pierre, are you arguing then that even though there's no correlation between poor economics in South Africa that we experience relative to market opportunities, is there a correlation, or could we argue that apart from the fact that we experiencing very, very volatile politics, there might be stimulus from a greater emerging economy perspective?
Yes, it is so that the link between economy and the markets is not such a tightly linked one. So one mustn't make the mistake. Over the long term, it'll apply, obviously, because if a country becomes a basket case completely, then ultimately it will reflect in your share prices. But over the periods that the market look forward, let's say 1 to 3 years, one mustn't make the mistake to think a weak economy or a struggling economy equals a struggling stock market. There's plenty of examples in the past where that timing hasn't worked exactly that way. On top of that, we need to take into account that more than 2/3 of our earnings come from overseas for the SA-listed companies. So there's also opportunities there. And the valuations are good, So again, I think the timing of improvement material improvement is uncertain, but if you buy at very cheap valuations, then that's on your side. And South African fundamentals aside, I think the biggest opportunities for us lies in being lifted by the tide of emerging markets generally. And what that means is, if emerging markets as a collective start outperforming and do well, we will be lifted by that and get the benefit of that through foreign inflows. We might not do as well as what we would have done had our house been completely in order from an economic point of view, but we will still do materially better than what we have done in the last number of years. So I think the reason why I say all of this is that there's a risk that people will fixate on the last 5 to 7 years of extremely disappointing returns in South Africa and think that that defines the future because we are all fairly pessimistic about South Africa. And I think that'll be a mistake for the reason that the weak performance of the last 5 to 7 years was not a pure SA story. It was really an emerging market story, and that story can change quite easily.
Thank you.
I think I'll stop there and I'll hand over to Dion.
Thank you for that perspective. I think it gives, it's always good to see it from the other way around. In terms of, I'm just putting this out here, please feel free not to comment on it if you're not comfortable. But in terms of the prescribed assets, I mean, the debate, it's a very hot topic in terms of where we're heading towards from a Regulation 28 perspective. I don't know, Dion, if you possibly want to take the question, but I mean, what are we doing in terms of that specific position? Is that something we need to look out for, or is it status quo at the moment?
Pierre, do you want to?
Yes, I'll speak to that. We think the risk of prescribed assets is not particularly large. You know, the news flow about that goes forwards and backwards a bit, but there seem to be indications and noises that the policymakers know it's a dangerous game to start playing. Point one. So we don't think it's that likely. Point two, if it were to happen, I think one will have time to react and plans to make. That's the second point. And the third point is the investment industry in South Africa has been very much on the front foot through their industry association, ASISA. So there are working groups that are actively engaging government and saying to government, listen, we are not against investing in infrastructure, but what we need vehicles that are transparent and that we can buy with confidence that we know are above board, won't be misused, there won't be leakage through corruption. So I think the industry is proactive and is doing the right thing by almost putting the ball in government's court to say, listen, we don't need prescribed assets. We'll willingly buy assets in infrastructure and uplifting and upbuilding projects if you can package it in a way that has the controls around it that we need. And I think that's a good tack to take as an industry.
Thank you for that. Yeah, I know we've also spoken historically in terms of possible restructure of some of the portfolios. I know one of the offerings that you have at NAVIGA includes the NAVIGA flexible mandate, which speaks directly to a more sort of aggressive approach in terms of the building blocks. Maybe we could at some point just elaborate on the underlying allocation relative to sort of the more balanced blended funds that we implement in the balanced portfolio specifically.
Yes, I'll address that in one of our slides.
Great, thanks.
So yeah, thank you, Luciano. So for today, I prepared 3 different portfolios just to give you an idea of the portfolio changes we've made during the last quarter and also the performance. So first up is NAVIGA Balance. That's your typical balance fund that is used for or clients that's saving for retirement. So currently the equity exposure is between 60 and 65% in this portfolio. So this is for long-term capital growth and it needs to comply with Regulation 28 of the Pension Funds Act. So it means it's not allowed to go more than 75% in equity and not more than 30% in offshore assets. As you can see here, it was impacted by COVID-19. It did experience a drawdown, but since then it has recovered this portfolio and we're back to the same level as at the start of the year. So we've also got a NAVIGA flexible portfolio that's taking more risk than NAVIGA balance. So this portfolio about 60 to 65% equities. We also have a portfolio that's taking maximum risk according to Reg 28. So it means 75% in equities, 30% in global assets, with currently about 8 to 9% in SA property. SA property, we can go up to 25%, but there's some risk in SA property, and that's why we're only at 8% versus the maximum of 25%. So NAVIGA flexible portfolio is ideal for clients that's got a long investment horizon and that's got many years until retirement. So it's a long investment horizon. It's not for someone that only wants to invest for a year or two.
Of course. Yeah, maybe just on that point, my apologies, Dion. The property exposure that you referred to in terms of that on the current levels, what your view specifically on property? I mean, so we've discussed the stimulus towards tech, and the reason for that is we were forced to embrace technology, and I've spoken to a lot of corporate clients, and all of them are reconsidering their leases in terms of retail spaces and so forth. What are our views from a property perspective in the portfolio? Erik, dink jy's gemute.
Apologies for that. Apologies for that. We are on the neutral side on property, reasonably kind of circumspect. The valuations look good because property have done quite poorly over the last number of years, and clearly in the downturn of this year as well. So the yields look good, and the property managers, you know, after all haircuts being applied to their calculations and all adjustments made, they still think one will get a double-digit return or a high single-digit return from property this year. So that compares well to bond yields, but as you've pointed out, you know, there are some serious challenges to property. So we just think one needs to be a bit, you know, we're definitely not overweight. One needs to see it for what it is and wait and see a bit. And I think active management is also important, you know, so you really need a good property manager. And within your other within your other funds, you need managers that very selectively buy property shares, because clearly there's better quality property assets and better quality property management teams. You know, it's not a homogeneous asset class. I think there were easy years for South African property, but increasingly in the last number of years and going forward, the distinctions between better quality assets and better quality management teams will be paramount.
Thank you. Thank you, Per.
So,
sorry to interrupt you, Dion.
Yes, on the underlying exposure. So what we've done during the last quarter was to increase the exposure to 91 Opportunity, which is follows a quality investment style. So quality investment style, as you can see in the first quarter, was one of the best performing styles. It provided the best protection out of all the balance funds in the first quarter. But during the second quarter, it lagged the other funds. It only delivered a 13% return versus 19-20% from the other balance funds within the portfolio. So we've decided to use this underperformance during the second quarter to increase the exposure to that quality style, that if we experience a second wave or another downturn in the markets, 91 Opportunity will provide better protection than the other balance funds. So we did increase that exposure to that fund during the quarter. As you can see, the other funds, the good news is that most of the balance funds recovered during the second and third quarter, many of them delivering almost 20% return. Coronation, Prudential, Net Group, which is a passive fund, and BCI Best Blend all delivered about 20% return for the second and third quarter. So a significant recovery during the second and third quarter. So it's typically your value styles that perform better during the second quarter. Then the NAVIGA low income portfolio, it's slightly more cautious. The focus here is slightly more tilted towards income instead of capital growth. So we were a bit more cautious with this portfolio, and since the beginning of this year, it delivered a 1.5% return. So it recovered and added additional 1.5% compared to the initial level at the start of the year. But this portfolio outperformed NAVIGA balance because we're slightly more cautious, had a a slight tilt towards income instead of capital growth. But if markets continue to recover, NAVIGA Balance will perform better because NAVIGA Balance has a goal of achieving long-term capital growth. Within NAVIGA Low Income, we did reduce equity slightly. Like I said, we've got a focus more on income than capital growth. So we did reduce the equity exposure as markets recovered. And we switched that to a flexible income fund. So in the current environment, flexible income funds should be able to deliver about 6% return versus money market of 4.3% and cash of 3.7%. So we like the valuation of SA bonds, but SA bonds on its own can be volatile, and that's why we opt for flexible incomes that can actively move between money market funds and SA bonds. And then you can expect about a 6% return out of flexible income. Currently, inflation is only 2%, so that gives you a decent inflation plus return by investing in a low-risk flexible income fund. And lastly, I've got NAVIGA Growth Portfolio. Here's no limitation such as Regulation 28. So the underlying fund managers can invest up to 100% in global assets or even in equities. So there's no limitation to a specific asset class. And during this year, this portfolio has done terrific, delivering about 16% return for year to date. So that's a terrific return compared to cash and other asset classes in South Africa.
Can I maybe just say something about that graph? This clearly illustrates why we in the industry often call the rand a shock absorber, because you can see there in the downturn, because of the weakening rand, which is now not great if you only focus on the value of the rand, but because of that weakening, your portfolio, if you had significant global exposure, were very much more protected compared to a SA-focused only portfolio.
So as Pierre said, most of that return was explained by a weaker rand. And at about 17.50 to the dollar, we started to reduce the global exposure. We're still slightly overweight in this portfolio, but we've reduced the global exposure when it was 17.50. Currently, the rand is below 17. So for now, it's been a good call to reduce that global exposure due to the stronger rand in this portfolio.
Fantastic. So re-looking and tilting the portfolio. So it's not we're not married to the actual asset allocation and the offshore drive that we've seen in some of the other portfolios historically. You're looking at actively rebalancing when relevant.
Yes.
And I think very important.
Some portfolios are limited by Regulation 28, so we need to make switches within the regulation. But some portfolios like NAVIGA Growth, there's no limitation. It's more volatile, but there's no limitation to the asset classes that can be used in that portfolio.
Brilliant.
I just want to make the point as well that in thinking about our portfolios, one must invest and go where the good opportunities are. You must not use your portfolio to vote for or against South Africa. That's not necessary. So, if you look at our portfolios and those of other good and prominent managers, typically what you would see is high foreign exposure and often even into the big tech stocks and the healthcare stocks that are defensive, but then also investments in SA bonds and SA resources companies, because if the cyclical global recovery that we expect plays out, commodities are going to do well, and our commodity shares and our miners are geared place on that. So you will do very well out of South African resource shares if a EM rest of the world led cyclical recovery unfolds in the next 3, 4, 5 years as the world sees the need to rebuild itself. So I just want to make the point, invest. Don't feel that you need to defend if you invest a lot offshore or selectively in South Africa. One should go where the best opportunities present themselves. Your investment portfolio is not the place to make a political statement. It might not, be the best outcome.
No, thank you for that, Pierre. I think what's imperative is when I consult with clients, obviously the sentiment is extremely negative relative to what's going on from a political perspective, and the drive really is for clients, wanting to hedge themselves and allocate as much as possible capital offshore. But I think the content of both of your presentations today, provides some comfort in that. So that we know that, the portfolios are actively managed, and it's actually looked after by a team of capable investment specialists that really looks at the global opportunities and rebalances the portfolios accordingly. So thank you very much for the input, gentlemen. I really do appreciate. And thank you for your time again to discuss the performance, and thank you for managing the portfolios actively. We're looking forward to speaking to you again soon, and hopefully we present some positive numbers, or more positive numbers, towards the end of the year in the last quarter.
Thank you. Thanks for having us.
Thank you. It was a pleasure.
Thank you, gentlemen.
Bye-bye.